The global oil market is heating up again, and this time the shockwaves are being felt directly in India. Brent crude prices are on fire. Futures have surged close to $119 per barrel after a nearly 29% spike in just days. For India, the world's third largest oil importer, this sudden surge is not just a market story. It is a serious economic warning. Now, amid this turmoil, the United States has offered India a short window of relief. Washington has granted a 30-day waiver allowing Indian refiners to import Russian crude that was already loaded and stranded at sea when new sanctions kicked in. The waiver is effective from March 5 to April 4. On paper, it looks like a lifeline for Indian energy companies. But the reality is far more complicated. According to analysts, the amount of Russian oil covered by this waiver is very small compared to India's enormous energy demand. Estimates suggest Indian refiners have bought more than 10 million barrels of Russian crude currently in transit. About 15 million barrels are in waters close to India, while another 7 million barrels are near Singapore. Several tankers are also moving through the Mediterranean and the Suez Canal toward Indian ports. Even if all of this oil reaches India under the waiver, it would barely scratch the surface of the country's energy needs. India consumes roughly 5 million barrels of crude oil every day. That means the stranded cargoes would cover only about 4 days of demand. Analysts say this may provide temporary logistical relief, but it will not change the bigger picture. Now, the real pressure is coming from global oil prices themselves. The benchmark Brent crude has jumped sharply amid fears that the conflict in West Asia could disrupt shipments through the Strait of Hormuz. This narrow sea passage carries nearly 20% of the world's oil supply. Any disruption there can send prices soaring across the globe. On Monday, Brent futures briefly touched $119.46 per barrel, marking the sharpest jump since early 2022. The rally was fueled by fears of supply disruptions as well as production cuts by major oil producers. Now, for India, the biggest risk is not just access to oil, but the price shock hitting the economy. India imports nearly 85% of the crude oil it consumes. When global oil prices surge, the impact quickly spreads across the economy. Fuel becomes more expensive, transport costs rises, inflation pressures increase, and the government's fiscal balance comes under strain. Now, over the past few years, Russian crude had helped soften this vulnerability. After the Ukraine war, India significantly increased imports from Russia because the oil was available at a discount. At one point, Russian crude accounted for around 35% of India's oil imports. But that dependence has already started to fall. Recent estimates suggest Russia now supplies roughly 20% of India's oil imports, while official data in December 2025 showed the share closer to 25%. Now, that means the current waiver helps clear a short-term supply bottleneck but does little to protect India from rising global prices. The macroeconomic risks are real. Research by the Reserve Bank of India shows that every 10% rise in crude prices can push inflation up by about 30 basis points and have roughly 15 basis points of GDP growth. With oil already jumping more than 22% in a week, the economic impact could be significant. Financial markets are already reacting to the pressure. Historically, sharp oil prices spikes tend to move in the opposite direction of Indian equities. Higher crude prices raise import bills and create uncertainty for investors. That often triggers volatility in benchmarks indices like the Nifty 50. So while the waiver may buy India a few days of breathing room, it does not solve the larger problem. As long as the global oil prices remain elevated, the Indian economy will remain exposed to the energy shock. Now, in simple terms, the stranded Russian barrels may help India for a few days, but they cannot shield the country from a global crude storm that is only beginning to intensify.